Hello, folks. Today we are going to talk about this brand new mortgage down payment assistance program that just came out literally a couple days ago. And the one I'm going to be talking about specifically is called a Cal HFA, Shared Appreciation, which pertains to home buyers in California. However, these programs are being rolled out across the country, so stay tuned, understand how this program works, and then you could do your research to see who's offering it in your area. So if you find value in this video, please consider subscribing and liking for more content related to finance, real estate, and mortgages. So let's dive right in. So the new program has been rolled out by Cal HFA, that stands for Housing Finance Agency, made for California home buyers who are first-time home buyers. So the definition of a first-time home buyer is someone who hasn't owned a property over the last 3 years. So you can't have owned a property over the last 3 years. So there's been a ton of down payment assistance programs, but this one is completely different, and I'm going to explain why. On a traditional down payment assistance, usually these programs are combined with FHA. So FHA is a minimum, 3.5% down, very low down payment. And the down payment assistance comes in and they give you the other 3.5%. That loan is then repaid or forgiven over a number of years. So the down payment assistance is a very small number. It's only 3.5%. However, with this down payment assistance, Cal HFA is going to come in and cover 20% of the down payment. So you're going to have a first mortgage for 80% and you make payments on that amount. The second mortgage, the down payment assistance, is 20%. There is no interest and no payments. It sounds amazing and too good to be true. However, there is a catch. Of course, the banks and the government are not doing this for free. So let me explain how shared appreciation works. So the bank or the government, Cal HFA, who have partnered up to do this program, they're essentially buying a house with you. They're investing in real estate with you. So they're going to give you 20% of the price of the house. So let's just say, for example, you buy a house for $500,000. They're going to give you 20% of that. So they're going to give you a loan for $100,000. Now, when it comes time to sell that home in the future, so you bought the home for $500,000. Let's say 3-4 years down the road, you decide to sell. Now, let's say, for example, just to use easy numbers, the value of the house is now $600,000. So it is appreciated $100,000. So when you go to sell that house, you have to pay back the $100,000 loan plus 20% of the appreciation. So you pay back 120%. So instead of a normal home buyer who sells their house and keeps 100% of the appreciation of the profit, they're going to give 20% to Cal HFA. That's how the program works. That's why it's called a shared appreciation mortgage, because you're sharing the appreciation with Cal HFA. You give them 20% of the appreciation. Everyone's happy. Now, there's mixed feelings about this program amongst myself, my colleagues. So let me know after you hear all the details at the end of the video. Feel free to leave a comment. Let me know if you think this is something you'd be interested in. Would you do something like this, or would you rather own the house completely by yourself and not have to share the appreciation with someone else? So let's just go into the details of this program. So like we said, first-time home buyer. Everyone who lives in the house has to be a first-time home buyer. You can't have owned a property over the last 3 years. You have to complete a home buyer certification. So probably a 4 to 8 hour course you do online. Got to get a certification. It has to be your primary residence, and there cannot be any non-occupying co-borrowers. So on a traditional mortgage, if you're getting a conventional loan, and let's say you don't have enough income to qualify, you can call up your dad, you can call up your brother, you can call up your sister and say, hey, can you co-sign? Your sister or brother, whoever's co-signing, can be in another state. They're not going to live in the house, but they have good income. So they co-sign the loan, help you qualify. You cannot do that in this case. No, everyone who signs the loan has to live in the house. Okay. So income limits. This is something that pretty much disqualified a lot of people in previous down payment assistance programs. With other down payment assistance programs, the income limit is very low, right? So the way it worked is, let's say you have to make $70,000 or less to buy a home in Los Angeles. Now, if you're making $70,000 or less as a family, as a household, I'm sorry to tell you, but you don't make enough money to get a mortgage, okay? Because the prices of the homes are so high. They set it up in a way where it was almost impossible to qualify for these down payment assistance. So what they did was they upped the limit. So I'm just going to give you one example. In LA County or certain parts of Los Angeles, you can get this program even if you as a household, so you, your spouse, or you by yourself, if you're the only one working, your income can be as high as $180,000. $180,000 a year, which is $15,000 a month, which means if you have no other debt, you can get a mortgage up to $7,500. So again, much higher income limit is going to open this up to a lot more people. Now, one other thing to mention again, this down payment assistance, like the example we used earlier of $100,000, no interest, no payments. It just sits there and you just make payments on the first mortgage. Now, they split up the appreciation sharing to two categories. So if you make over a certain amount, so each area has something called AMI, adjusted median income. So if you're between 80 and 150% of the area you're buying a house, if your income is between 80 and 150%, they're going to take 20% of the appreciation. If your income is less than 80%, they're going to take 15% of the appreciation. So again, if you're under 80%, you're probably not even going to qualify to buy a house in Los Angeles or most places, because the way it's set up, if your income is that low, I mean, there's really not many houses on the market that you can get. So the next thing to know, okay, the maximum loan amount that they're going to give you as far as a second down payment assistance is $200,000. Okay, so they're going to give you up to $200,000. That equates to about a home of around, again, LA County. We're talking a $900,000 home. They'll give you 20%. The maximum loan that you can get on a first mortgage is $726,000. So you get a first mortgage of $726,000. They'll give you up to $200,000. That takes you to $926,000. And then if you have money, if you want to contribute another 5 or 10%, you can do that. Totally fine. And how much money are they making available? So that's the next big question. Kind of important, because the way I see this, it looks like this program will not last very long because of the funds that have been made available. So again, this might be a pilot. If it goes well, these numbers may increase. But as of right now, and this program came out 3 days ago, so brand new, they're allocating $500 million to this program. Okay, so $500 million for all of California. Again, check your states, might be different amounts. But let's break that down. So if you got $500 million and the maximum amount is $200,000, let's just assume everyone takes out the maximum amount, just to make the numbers easy. That equates to 2,500 loans. So they're going to be able to help out 2,500 people with this program. So I don't think it's going to last very long. And again, not to rush you to buy a house, but if you're on the fence, you're trying to save money, you're trying to save the down payment, and you haven't gotten there yet. Maybe you just paid off a lot of debt, and now you're like, all right, I'm going to start saving for my next home purchase. This is perfect for you. You get your whole down payment of 20% covered. What that also means is when you have that first mortgage of 80%, you have no mortgage insurance. So that's good. No interest on this loan. That's good. The only time you're going to have to essentially pay, the only way they make money is once you go to sell the house or refinance, In the future, they're going to want 20% of the appreciation, whatever that may be. Now, all of that sounds great and dandy. However, there are two sides to the coin. I've had clients in the past who've had this loan and they couldn't wait to get out of it because every month you see the value of your home increasing, and you know that a portion of that is you're not going to be able to keep it. You're going to have to pay this back to Cal HFA. So there is two sides. It's not all rainbows and fairies. If inflation picks up, if the Fed starts printing money and we start seeing assets rising like real estate and your home value starts shooting up, you're going to want to get out of this loan as soon as possible. And again, some people don't love the idea of having to give 20% of their profits to the government, to Cal HFA. So, I feel like there is positives and negatives. Again, not fun, especially when, over the last 2 years during COVID, home values were skyrocketing. It's not fun to share that 20%. So what I would suggest is if you get this loan, have an exit strategy within a couple of years. That way you're not waiting 5, 10, 20 years. I mean, you definitely don't want to wait 20 years because home values in 20 years, the appreciation from now to 2043 is going to be insane, and you don't want to pay a ton of your profits, of your appreciation to the government. One other quick fact about this program: the maximum appreciation is 2.5 times the loan amount. So if they gave you $100,000, the maximum you would have to pay back is $250,000, which is 2.5 times. So just something to consider. And again, if you found value, let me know actually what you guys think about this. Is this a program you would consider participating in, or hell no, I do not want to give part of my appreciation to the government. I would rather find a way to qualify on my own. So let me know your thoughts. I would love to hear from you guys. And again, if you found any value, please drop a like and subscribe for more content. Really appreciate all your support. See you on the next one.